Today on Retire with Purpose, 3 huge tax mistakes to avoid, and I'm challenged by a viewer on my focus on fees and expenses, the importance thereof, and using your 401k wisely.
Are you prepared to retire with purpose? To retire knowing your savings is invested to meet unavoidable needs and expenses.
It's not how much we make during the good times, it's how much we keep during those really bad times.
Certified financial planner Casey Weed is president of Howard Bailey, an advisory firm that believes successful retirement begins with a detailed financial plan personalized to help achieve your life's purpose.
Whatever risk you faced, we've got a plan.
The Howard Bailey team is committed to practical financial planning so you can enjoy family and the future without uncertainty or stress. Stay tuned and learn how you too can retire with purpose.
Thanks for joining us. I'm Lee Kelso here with Casey Weed. He's a certified financial planner and the president of Howard Bailey Financial. We're beginning the program today taking a look at some of the details of an article from MarketWatch on 3 huge tax mistakes that retirees tend to make.
That's right, and I found a lot of value in this article. I think one is a lot of retirees have overlooked one of the biggest risks they have as they step into retirement. You know, we think about income planning, we think about healthcare planning. How am I going to have enough income to last the rest of my life? How am I going to cover my healthcare costs? These are the 2 biggest concerns that retirees have, but I think a lot of them are missing the boat on one of the biggest liabilities they have, which is their 401ks. Today there's about $22 trillion in retirement assets in the U.S. alone, of which 96% have never been taxed. These are tax-deferred retirement accounts that will come back to you as ordinary income, whether you want to take those distributions or not. At some point, they're going to force those distributions. And I'll have some folks say, well, I'm a millionaire. You know, I've got $1 million in my 401k. But the fact is, you don't, because Uncle Sam needs his cut. And it might be to the tune of 30%. It might be $250,000 of your million that you've saved is actually still owed back to Uncle Sam. And so we need to figure out how we can undo this tax burden and make sure that we keep as much money in your pockets where it belongs. And this article walked us through really, I think, some things that aren't necessarily just strategies we have to understand, but things that we should really know in general about how our retirement accounts work, how our Social Security works, and some basic ideas about what we can do about it. And that's what I try to include in my weekend reading, things that keep you updated and abreast of current financial planning and retirement planning topics, and some ideas and ideas that you can actually implement.
And if you'd like to enroll in the retirement with the weekend reading for retirees and pre-retirees, just go to the retirewithpurpose.com website. You'll see a little form there where you can just fill out a simple email request and you'll be able to get signed up. And you will receive a couple of articles coming in your mail each week, all curated by Casey with some additional thoughts and notes on where he finds value. Now, in this article, this is the one I thought was interesting, and that is we're all assuming that we're going to be in a lower tax bracket in retirement. Big mistake. Yeah,
well, and I don't know that everyone is assuming that they're going to be in a lower tax rate environment in retirement. That's somewhat evolving. Historically, that's what most people have always thought. That's why they said, well, I'm going to make tax-deductible IRA contributions instead of, say, contributing to a Roth IRA. But I think this is starting to change. You know, when I sit in front of a room of 50 people or 100 people and I say, how many of you think that taxes are going to be lower in the future than they are today, I get 100% participation because nobody is willing to raise their hands. And that's because people are starting to really understand the tax burden that we're going to face in the future due to some of the liabilities our government has. You know, when it comes to government-based liabilities, we're currently facing $21 trillion in government debt, and there's about $22 trillion in untaxed retirement accounts. They know this. Economists say that if we just look at Social Security and Medicare, the unfunded liability there is about $200 trillion. And they know that they usually say there's 1 of 2 ways they do this. Either they decrease spending or they increase taxes. And it'll most likely be a combination of these 2 things. But there's something that you might be able to take advantage of today due to the Tax Cuts and Jobs Act. You know, our new tax laws have prevented a really just massive opportunity for Roth conversion, where it might make sense for you to start to take some of your IRA dollars and convert them to Roth IRA and pay the taxes in a lower tax rate rate environment than you might face during your retirement years. And it used to be common sense that a married couple or even an individual would convert all the way up to the 25% tax bracket, but that didn't leave a lot of room for very many people. That was about $150,000 in taxable income. Now the 24% tax bracket goes all the way up to $315,000, and you've got about a doubled standard deduction. So we've got a lot of room to start lowering your taxes in retirement by locking in lower tax rates today.
The article also says that the IRA balances are a serious threat because of Social Security taxation. Explain that for me.
Well, and the article explained, and first of all, I don't think that a lot of retirees understand that their Social Security income is actually a taxable source of income, or it could be. And for most affluent retirees, they're going to pay taxes on their Social Security. And that is, the author actually said, doing his studies, that someone that pays taxes on their Social Security will run out of money 5 to 7 years sooner than someone that avoids paying taxes on their Social Security. 5 to 7 years is a pretty significant chunk of time. And if you look at how Social Security is taxed, it's taxed by something known as provisional income, also combined income. So you take all your different income sources, your IRA distributions, take into consideration municipal bond income, half your Social Security, add that up. If it's over $44,000 for a married couple, then up to 85% of your Social Security benefits could become taxable. And the article explains it's not just Roth conversions that you could take advantage of, but you can actually today, you don't have to have an IRA in order to do a Roth conversion. You can actually do a Roth conversion within your 401k. So you can stay with your employer and convert dollars from traditional 401k to Roth 401k, the caveat being you have to pay for those taxes somewhere outside of the plan.
Gotcha. And then we're not taking advantage of the Roth IRA as well as we should, and also the 401k, right?
I don't think we are, and we're going to talk more about the benefits of a 401k here later in the show and why more people should be taking advantage of the matching contributions they get from their employer, or making Roth contributions for that matter. I think just looking at the $22 trillion that's out there, 96% of it being tax deferred, people aren't really taking advantage of Roth IRAs and Roth 401ks like they should be today. And one of the things that we find quite often is we've got individuals that are building up an emergency fund. Maybe you have money in a money market or a savings account. You've got some taxable dollars there. And if you're married, you could move maybe up to $13,000 into a Roth IRA out of that savings account, and it still works as an emergency fund. A Roth IRA makes a pretty darn good emergency fund because you can take your contributions back out of there without taxes and without penalties. And so it makes it pretty good, especially in this low of an interest rate environment. We can make a lot of sense out of just keeping it in money market inside of a Roth IRA. If you never use it for emergencies, then you've got a tax-free retirement account that you can use down the road. But if you miss that opportunity this year, then you're going to miss 1 year that you can't get back.
So I think the bottom line here is there might be strategies and tactics that we tend to be missing, and it's wise to sit down with someone who knows how to play this game well. And I think those are the folks at Howard Bailey. So be one of the next 10 people to call the number on your screen right now and request a complimentary review of your retirement plan. It'll take a look at whether or not you are positioning yourself to avoid some of these tax time bomb issues down the road. Is there an income opportunity that you can't outlive? What are you going to do about long-term care? Is that provisioned in exactly what you're planning for right now? Lots of important issues to be covered, and you'll walk through all of that with a member of the Howard Bailey team if you're one of the next 10 people to call the number on your screen and request that complimentary retirement review. When we come back, we're answering your questions, so stay with us.
At Howard Bailey Financial, every dollar has a purpose. We call it the purpose-based retirement. A certified financial planner will help you decide what you need your retirement money to do for you. We put together a written plan that puts your dollars exactly where you want them to be. And we put every dollar to work to maximize your retirement efficiency. For a higher level of insight and care, choose the purpose-based retirement from Howard Bailey Financial. Call us now to set a complimentary consultation.
We are starting our viewer questions today in Walkerton, Indiana. Go right ahead.
I think you overemphasize the importance of fees on your shows. Who cares what I'm paying if I'm getting a good performance?
Well, Kathy, that cuts deep, but I appreciate your honesty, and I'm glad you're asking the question. Thank you so much for actually presenting the question in the first place. You know, I think that fees and expenses are incredibly important when it comes mainly to your investments, and so does Morningstar. Morningstar has done their own research. They've got a white paper out there that says the #1 determinant of long-term performance, and I'm sure Jack Bogle would agree with this, that it is keeping your fees and expenses low, because most mutual funds tend to underperform their benchmarks, and so let's keep those fees and expenses low. Being that Morningstar, you know, one of the largest research firms in the United States, says that that's the #1 determinant, I think we need to pay attention to it. However, I'm not saying that there aren't some funds that tend to outperform that are a little bit more expensive. We have used funds ourselves, index funds and ETFs, that have a little bit higher expense ratio, and they have outperformed. And sometimes that expense ratio and the total expenses of the fund might be due to further trading and turnover, more active management within the fund, and sometimes that does lead to better performance, but the majority of the time it does not. I think where you benefit from paying higher cost or higher fees is not in the actual investments that you use, not the higher cost mutual fund or ETF, but actually paying for financial advice, not investment advice, but working with an advisor who can be there to reduce your taxes, who can implement healthcare strategies, implement income strategies, and ensure that you can endure the next market downturn. You've got a backup plan, you've got an emotional partner and a financial coach to bring the team together, your CPA and attorney and you and your family, to make sure you have one person you can rely on to make sure there's nothing that's falling through the cracks.
All right, let's get to South Bend. And Pam, and your question, Pam.
I'm still working at 67, and I don't need the extra income, but would it be worth starting my Social Security benefits and just reinvesting that money?
Pam, that's an excellent question, and I think that the issue here is the assumptions that are used, because I can take your Social Security and I can do a projection. We have Social Security software that allows us to plug in the numbers. It allows us to plug in the numbers and say, well, this is our reinvestment rate of return, and we're not going to spend the dollars, so let's see what that actually turns into. And we can find the right filing strategy and see if it's better off for you to reinvest those dollars. But again, it comes down to the assumptions. If we assume that we're going to make 7 to 8% on those dollars that are reinvested, then absolutely, you should be going ahead and filing for your Social Security. But if it makes 3%, if it makes 2%, or if it loses money, then you would have been better off delaying those Social Security benefits into the future. So it's all about the assumptions. And, you know, my typical recommendation is, you know, let's delay Social Security until we actually need the money. That's more of a sure thing. We know that we're getting an 8% increase in those Social Security benefits every single year as we delay those benefits into the future, and we're getting an inflation-adjusted income that we know is going to be there for us when we're 90, 95, 100 if we make it that long. And so we've got this long-term inflation-adjusted income. But I'm glad you're asking the question, and I just really have you scrutinize the assumptions that you're making upon making that determination to take that Social Security. Now you've reached age 67, you're at your full retirement age, so continuing to work won't reduce those Social Security benefits.
Doug in Decatur sent in an email to info@howardbailey.com. We've got it here for you. I've seen 2 different advisors. One told me I'm good to retire. The other said I need to cut back spending or save more. Now I'm confused. How do I know who to believe?
Without a doubt, one of my biggest frustrations in the financial world, and again, I guess this kind of goes back to a previous question, it's all about the assumptions that you're actually making, the inputs that are being made into the financial plan. And we had a situation here recently with a couple from Mishawaka that we met with. Chris and I, we met with this couple up there, and what he had done is he sat down and he said, let's figure out your required rate of return. And the required rate of return, in order to make sure they had enough money to last the rest of their life and cover all the risks, was 3.3% per year. So we showed him this projection of 3.3% a year. That's what you need to know that you're going to be okay. And he got it. He said, you know, I like this. Now, his spouse, she was very defensive, kind of upset that she said, well, 3.3%, that's not fair. This guy over here, they were down between 2 different financial advisors. They said, well, he said he could get a 6% or 7%. I don't think 3.3% is enough? And that's asking the wrong question. You know, I think what we need to do, we had Todd Tressiter on the podcast not long ago, and he said you really need to make sure you understand the assumptions, because if we just adjust your inflation rate from 3% down to 2% or just lower it 0.5%, that can mean the difference between success and failure. Same thing is true about your investment return, taking it from 6% to 5.5%. I think Dirk Cotton, one of our other podcast guests, did a really good job because he's a statistical analysis guy, a computer science major, and he did a lot of statistics in his career. Now he's a retirement researcher, and he said what you need to do when it comes to your retirement planning is not focus on the average, not focus on the best case scenario. He said figure out the worst case scenario, and for them it was, well, it's 3.3% is what we need. So let's set this plan up to make sure that we're always going to be able to sustain our retirement in the worst case scenario. Then we can look at the average. Maybe the average is 5 or 6%. We can look at the best. Maybe the best is 7 or 8%, but always know what that worst case scenario is. And Dirk went on to explain, being a statistician, he said statistics are used widely in the financial world when it comes to financial planning. And it's not the 90% chance of success that's really valuable. It's knowing what that 10% chance of failure is. If you identify what the 10% chance of failure is, then you can plan against it. So that might be outliving your assets. So put together a portion of your assets that create guaranteed lifetime income so you know you're never going to run out of money. Maybe it's long-term care expenses. So purchase long-term care insurance or put a long-term care strategy in place to cover that risk. And if you have leftover assets, then you can allocate them to take advantage of the 90% chance that you're going to get that 6% or 7% a year.
Yeah, you know, and I think that's so important. You just mentioned there you have to understand those assumptions. If your financial advisor is planning on a 2% inflation rate, man, that's a tiny margin. That could blow way out.
Yeah, and we have to plan on the worst case scenario and know what all those different scenarios are. And that's the tough part, is that we're not statisticians.
Right,
you know, financial advisors aren't statisticians typically, and you know, most investors aren't statisticians. And so trying to plan your retirement on an average can be very flawed if you don't really understand what an average means. And that's why we have to focus on these worst case scenarios.
Yeah, and I think that's one of the reasons you want somebody who's very clear-minded, independent, and who really does have your best interests at heart. And I think that's what you'll get if you pick up the phone and call the number on your screen and request a complimentary review with a member of the Howard Bailey team. It's a chance to sit down with someone who really is interested in your best future and trying to help you plan for income that you cannot outlive, covering those healthcare costs that are definitely going to be out there in the future and may not be accounted for in your current planning. So many other factors, fees and taxes, those tax time bomb issues we've talked about so many times, all things to think about and will be covered as you sit down with a member of the Howard Bailey team. If you call the number on your screen and request a complimentary review of your retirement plan, it's time well spent. I hope you'll pick up on that opportunity. All right, here's our question of the day, and it has to do with how much money is currently sitting on the sidelines. What is the amount of money currently sitting in retirement accounts in the U.S. alone? We have the answer when we come back.
At Howard Bailey Financial, every dollar has a purpose. We call it the purpose-based retirement. A certified financial planner will help you decide what you need your retirement money to do for you. We put together a written plan that puts your dollars exactly where you want them to be. And we put every dollar to work to maximize your retirement efficiency. For a higher level of insight and care, choose the purpose-based retirement from Howard Bailey Financial. Call us now to set a complimentary consultation.
Let's give you the answer to our question of the day. It was, how much money is currently sitting in retirement accounts in the United States alone? These are big numbers, Casey. Which one is correct?
Well, Lee, the answer is all the way there at the bottom of the screen. The answer is D, $22 trillion. And we mentioned this number earlier in the show. And I think the really interesting and really important part about this $22 trillion is 96% of that $22 trillion is set aside in retirement accounts that have never been taxed taxed, and these are largely 401ks or traditional IRAs. And so what we're going to talk about here today is we're going to talk about 401ks, because I think we need to, one, understand how your 401k functions, the benefits of that 401k. We also need to understand the different places we can put funds within that 401k for different types of tax benefits. So what we're going to do is walk through the 4 tax buckets, and then we're going to walk through the biggest benefit of your 401k and back to revisit these 4 tax buckets. So the tax buckets start with the one that's probably most familiar to you, and that first tax bucket is your taxable bucket. This is going to contain things like maybe CDs, bank accounts, brokerage accounts, maybe even trusts for that matter, and your traditional, say, revocable living trusts and things such as that. These are accounts that you get taxed on every year. You receive something in the mail called a 1099. So you might make 4% on that CD if you're lucky enough to have one pay that much, and at the end of the year you have a 1099. Then you have to pay taxes on those gains in that account. Maybe it's 20% of that 4%, so you end up actually netting, say, 3.2% in reality. And so we need to understand how that taxable benefit, how that taxable bucket works, and what the net return is that we're getting every year. Now the next step is we can move money from those taxable funds over to the tax-deferred bucket, and that tax-deferred bucket is going to be made up of things like your IRAs, your traditional 401k contributions. So these are contributions you make that you get a tax deduction for. They're tax deferred into the future, and then you're able to take those funds out, but they're going to be taxed at ordinary income tax rates. This could also include savings bonds. It can include non-qualified annuities where you're tax deferred on those gains, and then when those funds come back out, you're going to have to pay taxes on your gains in the future. Better yet, we could move funds into the tax-free bucket. In that tax-free bucket, you might think about municipal bonds that could be both federally tax-free and state tax-free, depending on which state you actually own those bonds in. You could have Roth IRAs or Roth 401ks where you don't get a tax deduction today, the dollars grow tax-free, and they can be taken out in the future tax-free. You might also include cash value life insurance in this bucket as well. Now, if you have a lot of funds, you might need to start thinking about the income and estate tax-free bucket. If you have enough funds available that might incur estate taxes, you may want to look into different trust structures, your irrevocable life insurance trust, your ILETs, your CRITs or CRATs, and different types of special trust that might be available to you. So I wanted to start here so that we could really understand the differences in these different types of buckets that we have and the importance of diversifying those tax buckets. There's no guarantee that the tax-free bucket is going to be better than the tax-deferred bucket, so let's diversify those things. Much like you diversify your investments, we need to also diversify our tax buckets. Now, there's a lot of benefits inside your 401k outside of, say, tax-deferred growth or tax-free growth, and these are largely come in the form of matching contributions. So let's talk about how matching contributions actually work. When we look at matching contributions, the most popular contribution or matching contribution is what's called a safe harbor match. That safe harbor match typically matches 100% of your first 3% of contribution, 50% of your next 2% of compensation or contribution. So let's say you make $50,000 a year, and that is a net 4% match. That means that you have $2,000 coming back to you in the way of your traditional safe harbor match. So let's break this down a little bit further and say that we're contributing 3%. So if we contribute 3% of $50,000, we contribute $1,500. They're going to match that at 100%, $1,500. So you're getting 100% guaranteed rate of return essentially on that contribution. Your total contribution is $3,000 and you only put in $1,500 of that. When you bump it up to 4%, you're going to get matched 50% of that next 1%. So now you're collecting an extra $250, your essential guaranteed rate of return being 87.5%. And then if you go up to the maximum match of 5%, you're collecting as much free money as you can possibly get. Your $2,500 goes in, they match $2,000, so you're getting essentially a guaranteed return of 80%. Total of $4,500 going into the 401k with you only adding $2,500. You have to pick up that free money. It's a no-brainer. After you get past 5%, they're not going to add any more dollars to that account, assuming your matching contribution is set up in this manner. So you might say that that contribution matches actually seeing a lower guaranteed rate of return over time, this is why it might make sense for you to look into other types of investment vehicles, like making a contribution to a Roth IRA instead of your Roth 401k after you pick up your full match. To break that down even further, we can take a look at what's happening at these different levels. If we contribute 3%, they're putting in $1,500, 100% return on those dollars. Contributing in that 3 to 5% range, you're essentially going to get a 50% guaranteed return on those dollars. So we want to get that 100%. We want to get that 50%. Beyond that, we may want to look into other investment vehicles. So to review our different tax buckets again, we have our tax-deferred bucket. We start with our taxable bucket. Then we come over to our tax-deferred bucket. Then we have our tax-free bucket. Then we have our income and our estate tax-free buckets. And the more money we have, the more we typically want to move it from the left all the way over here to the right. Everybody likes the idea of tax-free, and I do too.
Yeah, so if I want to put this strategy to work, where do I start? Who do I work with? Is it my CPA? Is it my financial advisor?
I think it starts by working with your financial planner. You know, for me, when I go to my CPA and ask them about these types of things, they refer me to a tax attorney to take care of more of the tax advantage strategies, more of the, I should say, advanced tax strategies that need to be implemented. And then I work with my financial planner, certified financial planner, Marshall Johnson, our vice president, and we put our heads together on the overall financial plan. We're really the architect, the coach to bring this legal team and this financial planning team, the CPA together and make sure that we have everything covered. But I think it starts with a financial planner because we're talking about planning for the future. And you know, CPAs do a great job of typically doing what they're trained to do, which is focus on today. We're focusing on keeping that taxable income as low as we possibly can. And this is just what they get rewarded for, right? We go in and give our CPAs hugs and kisses when they give us lower taxable income. That's what they get rewarded for. If they increase your taxable income in lieu of benefits you might receive down the road, boy, they might not get as big of a high five this year. And so I think it's important to work with a financial planner to actually have them look at your overall financial situation and find any gaps that might occur in your actual tax plan itself, then bring in a CPA and have them go through the finer details of intricacies because they really understand tax law way better than a financial advisor is going to. And then if you need some more advanced estate planning or more advanced business tax planning, then maybe you're going out to a tax attorney. And all of these different layers, they do incur a cost. Working with a financial advisor is one cost, working with a CPA is another, and a tax attorney might be another layer of cost. So it doesn't necessarily make sense to bring all three of these people in until you have the wealth to justify it.
So if I'm working with really somebody who's a broker, a captive broker, I'm not going to get this kind of advice, right?
Not necessarily, you know, and there are some brokers that are out there that have really good advanced tax planning that they're able to implement, but some of these firms have told their advisors that they can't even mention taxes when they're approaching conversations with their clients. I have two advisors I've worked with that came from one of these firms, and they said, I just don't understand why we couldn't talk about one of the only areas that they could actually get guarantees in their financial life, especially if we're ultimately going to work with a CPA to implement the strategy. We should be talking about what I consider the heartbeat of your financial life, which is your 1040. If we're not talking about that, we're missing the boat.
So if you'd like to have that conversation, I encourage you to pick up the phone and start a conversation with Howard Bailey. Call the number on your screen and you'll be able to request a complimentary review of what's going on in your retirement plan. Is this tax strategy something that you're missing out on? What about long-term care planning, a lifetime of income that you cannot outlive? All things that you'll be talking about when you sit down with a member of the Howard Bailey team after you call the number on your screen. Thank you for joining us today. We will see you next week.